Hey, Sue!
Bev, you're sitting on a monster.
Literally and figuratively. It's my superannuation from Australian Retirement Trust.
Australian Retirement Trust. Right.
Big, isn't it? Comes with an app.
I gotta get me one of those.
One day, I'll unleash it on the world. Maybe even Barbados. Barbados, baby!
Awaken your super with Australian Retirement Trust.
Hi and welcome to this new series in our broadcast. My name is Joshua Van Gestel. I'm the Senior Manager of Education here at ART, and it is wonderful to have you with us over this series of events in coming weeks. In this first event, we'll actually be talking about one of the main parts of your superannuation, contributions, but also thinking about how you self can take control of contributions, and also not just how it will fund for your retirement, but how it gives you opportunities today, including in your tax. I'm going to have a couple of guests assisting me in today's broadcast who I'll introduce a little later. But before we get started though, I'd like to acknowledge the traditional owners from the lands on which we are recording in the Turrbal and Yagara Nation, as well as the many lands that you are coming from. But if I can also make special mention to the traditional owners of the Darug Nation, where I come from in northwest Sydney. I'd like to also acknowledge that today's broadcast is of a general advice nature only. There's probably a lot of questions that you may have as a result of watching this, and we do in fact encourage that. And as you're seeking answers, we also encourage you to look at our website and reach out to us where it is pertinent. Now, before I hand over to one of our education specialists, Pat Dunlop, to take us through some of the fundamental things to think about with contributions, I'd like to first, for those of you who may not know us well, introduce Australian Retirement Trust. We are one of the largest superannuation funds in Australia, and we're proud of that. But what makes us truly proud is what differentiates us. We are a fund that works for our members, not for shareholders. We're not owned by another institution or listed company. Instead, any profit we make returns to our members through improved fees and improved services. We also are a fund that is solely focused on our member experience and what we're driving for them. And so it's really important to us to make sure that we are giving our members the strongest possible investment performance, particularly over the long term. And we're very proud of the returns that we've achieved consistently over many years. But we also believe that it is our members' right to have access to information, guidance and financial advice to help empower you and give you confidence around your retirement decisions. So we'll talk about throughout this series different tools and calculators and ways that you can find out information, including how you can connect with us to receive advice, whether that's digital, through a conversation or through a meeting. We encourage you to find the information you need to make sure that you are more confident with your superannuation and the decisions you make. Now, this event tonight is probably coming to many of you at very different stages in your superannuation and retirement journey. And it's important to think about where you're at in this journey, because the opportunities that you'll have and the way that you can leverage them will be slightly different based on where you are. For those of you who are younger, making small decisions when it comes to your superannuation today can have enormous impact over the many decades to come. And this is something that our guest presenters will be speaking to. But for those of you who approach retirement, maybe you're in a position where you're transitioning to retirement, some of those impacts become lesser, because you don't have time and compound interest as much ahead of you to do some work for you. Instead, you might need to think about taking bolder action when it comes to your superannuation to try and really make it change as you approach retirement. These are all things that we will unpack throughout this program. how you think about growing your superannuation through contributions and investments, how you continue to do that as you're transitioning to retirement, and then how you should be thinking about your superannuation, particularly from an investment perspective, as you are thriving and entering into retirement. But the first part of the journey I would encourage for any of you is, if you have more than one superannuation fund, as many of us do, consider bringing that together. Consider combining your superannuation where it makes sense to do so, noting that where you've got multiple funds, it means you're paying multiple fees, potentially you'll have multiple insurances, and it also can be easier for you to lose track or not be in as much control of your superannuation. We encourage you, though, before you make any decision to combine or consolidate your super, that you do look into it and that you do assess areas such as insurance that you may have with different funds that you could lose access to as a result of making any change. But it is the starting point to build a strong foundation that your contributions, investment earnings and other decisions you make can then build upon. Now, as I said, I'll be passing to Pat Dunlop in a moment, who's one of our wonderful education specialists at ART. But just to introduce what Pat's going to be talking about, there is a landscape in the ways that you can actually make contributions to your super. And this is often really confusing. People get overwhelmed by the different terms, the different methods, the different ways that they can put money into super. And part of what we're wanting to do today is to simplify that. There are two main ways that you can put money into superannuation. The first is through an employer arrangement generally, or through a tax arrangement. And what I mean by that is what we call concessional or pre-tax contributions. These are basically any contributions that your employer puts in on your behalf, which Pat will talk to, as well as any contributions that you ask your employer to put into your superannuation before they calculate income tax on your earnings, as well as any contribution you make to your super that you then subsequently claim as a tax deduction. Where these are all similar is that when they enter into your superannuation account, up to 15% tax will be deducted, and that's a concessional rate of tax. But the main thing to remember here is that these are monies that are either going in through an employer arrangement that they're making on your behalf or you're directing them to, or a contribution that you're making that you're claiming as a tax deduction. I don't want to steal any more of Pat's thunder though. The other side of this contribution landscape is to consider post-tax contributions. And this is something that we'll have a guest speaker come and join us on, Trustee, who will go through the main considerations here. But very high level, this is where you make contributions yourself or a spouse makes contributions for you into your super that you do not claim as a tax deduction. Now, there are some other ways that you can have contribution monies flow into your superannuation. That includes incentives from the government, as well as later in life, selling down your principal residence and putting some of those proceeds into your super. We will unpack all of this over the course of this program for you. Now, before I hand to Pat, the last thing to consider here, and where superannuation is beautiful above just about any other investment vehicle, is that superannuation exists in the long term. It is something that is with you often for decades. And that means that a contribution that you make today will have investment earnings go on it, and that will compound year after year after year to actually grow your superannuation balance for retirement. In fact, at the point of retirement, the bulk of your balance will not be made up of contributions. It will be made up of the investment earnings as a result of the investment decisions that you have made for the many decades before you access it. So if we just think about these two scenarios, We've got one scenario where a person is making a regular, smaller contribution throughout a big portion of their working life. And what you can see is that small amount has the advantage of earning investment returns on it for a very long period. And we compare that to what happens if you make the same amount of contributions over time, but you do that in bigger chunks in a shorter period. And the outcome here is that by investing sooner, by making those contributions earlier and more regularly, you're actually going to end up better off over the long term. And this is why I said a few moments ago that if you're younger, the decisions that you make can have a powerful compounding effect over time than if you're making a sudden or larger contribution at one point in time. Now, really, your journey, your age, your stage will determine what you can do here, whether you have time ahead of you or whether you're having to make some larger moves to get contributions into your account. On that note, though, I would like to hand over to Pat Dunlop, one of our education specialists, to talk a lot more about the basis of contributions into your super. Over to you, Pat.
Thanks, Josh. As mentioned, my name is Patrick. I'm an education specialist with ART, and I'm going to take you through all of those before-tax contributions. So first things first, what are before-tax contributions? In the industry, they're known as concessional contributions because it means that you receive a concessional rate of tax on those contributions, so a lower rate. Personally, I don't like that term, so I will keep referring to them as before-tax contributions. Now, as Josh mentioned, the first type of before-tax contribution you'd receive into your superannuation is what you'd receive from your employer. Now, for most Australians, that would be the superannuation guarantee, which is currently set at a rate of 12% of your salary. Now, if you have an ART corporate account or even a QSuper account, you may have different arrangements in relation to how much you receive from your employer. It's important to understand what those arrangements are because it does play a part in how much you can put into super. The second type of before-tax contribution are salary sacrifice contributions. Now, this is done through a pay office. So what that means is you're actually telling your pay office to put contributions through to your super fund before they get taxed in amongst your income tax. And as a result of that, you pay a lower rate of tax going into super. Now, if you don't have a pay office, so for example, maybe you're self-employed, you're a sole trader, that kind of thing, you may look to actually make a contribution into super and then claim it as a tax deduction. So it'd actually go in as an after-tax contribution, you then fill out a form and then it counts towards the before-tax limits. Now, the before-tax limit for the current financial year is $32,500. You may be able to do a little bit more than that, and I'll get into that later. But again, it's important to understand what your employer is paying in because that also counts to that $32,500 limit that you can see on screen. So when we look at salary sacrificing, as I mentioned, it's a way to make contributions to super to save money on tax. So for someone who isn't doing it, this is what would happen. You would have your full salary, it would go through the income tax system, and then any contribution you choose to make to super would then flow through to your super account. And what that means is that that contribution would form part of your income, and as a result, it would get taxed at your personal income tax rate. For most Australians, that's 32% or even higher. When you salary sacrifice, as I mentioned before, you are asking your employer to make those contributions through to your super account before your money gets taxed. And what happens is that individual contribution itself, when it hits your nominated super fund, pays a reduced amount of tax, only 15% versus your income tax rate. And the reason it's called salary sacrifice, every time you contribute this way, it actually comes off your taxable income because your taxable income will reduce, your income tax reduces as well. So you actually end up with 2 tax savings, and that's where super gets exciting. So it's up to you to figure out what you do with those tax savings. So the more that you actually look to salary sacrifice, the more tax savings you get, meaning the more you can salary sacrifice. Obviously, it's very important to keep in mind you are restricted to that $32,500 limit. Now, if you are a sole trader, or for example, your employer doesn't allow you to do salary sacrifice arrangements, you may look to do it in another way, and this is via claiming a tax deduction. Now, the way that this works is you would make a contribution into your super account from, say, your bank account, via BPay, via check cash, whatever it may be. That would go into your account. You have to do this before the 30th of June. You then jump onto the ART website and you look for the form to claim a tax deduction. Now, on that form, you let us know how much of that contribution you wish to claim as a tax deduction, again, remembering that $32,500 limit. You then send that claim form through to us. Once we receive it, we will acknowledge it and send you out a form. You can think of this essentially as a receipt. And once you've been sent that receipt, and only then, you can then lodge your tax return. It's important to point out you cannot lodge your tax return until you've received that notice from ART, otherwise it will not count as a tax deduction. So essentially, think of it this way: if you put in $10,000 and you decided to claim all that $10,000 as a tax deduction, that would mean $10,000 would come off your taxable income, meaning you end up paying less income tax. Now, I keep saying that is mainly for sole traders and for the self-employed. It is for people who aren't able to do salary sacrifice arrangements through their employer, but anyone is able to do it. Again, I keep saying this, up to that $32,500. But with that in mind, a lot of people want to get more money into super on a before tax basis so they get those tax advantages. And I often get asked, am I able to put in more than the $32,500? And the answer is potentially. So you may be able to put in more money because of a new idea that has been around for a number of years now, meaning that any unused amounts of previous financial years can actually be carried forward for up to 5 financial years. So I'm going to show you what that looks like. But let's just imagine that this person, they understand they have $32,500 as their before tax limit. They get their 12% from their employer, so 12% on $100,000 would be $12,000. That would count towards that $32,500. And then let's just imagine that this person decides to use up the rest of their $32,500 cap via salary sacrifice contributions or by claiming a tax deduction or both. So for this person, they would have completely maxed out their limit. But like I said before, going back 5 financial years, as long as your balance is less than $500,000, any amount of that previous limit you haven't used can be carried forward for up to 5 financial years. So to give an idea of what I mean by this, let's take this example. So last financial year, just to throw a spanner in the works, last financial year the before tax limit was $30,000. On the 1st of July this financial year it did go up to $32,500, but we're using last year's limits. So this person last year put in this amount of contributions to count towards the $30,000 last year, meaning that this amount was unused. As long as their balance is less than $500,000, they can actually carry forward that unused amount to be used in this financial year, and like I said, up to 5 financial years in future. Now, if you want to know exactly how much you have available in relation to this, I do encourage you, log into your MyGov account, click on ATO and then Super, and then you're looking for all the C's. Concessional Contribution Carry Forward Cap. It'll show you the exact dollar figure that you can do, and of course, the more that you put in on a before tax basis, the more you're going to build up your super for your retirement and get those tax benefits. But that is it from me. I'll throw back to you. Thanks, Josh.
Thanks very much, Pat. Now, it is really important to again think about what Pat was saying in context of the longer term potential that it offers you. And if I think about why you may want to contribute more to your super, those are decisions that you're making now that potentially can really help you in your retirement. And as Pat has outlined, a lot of people do pre-tax salary sacrifice contributions or contributions where they claim a tax deduction because it gives them a benefit today as well as helps them towards the future. And what we've got here is an individual who's decided to make additional contributions into their superannuation. And what we want to look at though is how that will impact differently based on the age at which they commence this. Now, remember I talked earlier about compound interest, and the earlier that you start making contributions, the longer it is sitting in your superannuation account, earning interest upon interest over time. So, if we look at the chart here, what we can see is that for someone who starts making additional salary sacrifice contributions in their 30s, that they're going to have an additional amount of income paid to them in retirement of about $266 per fortnight. For someone who then starts that journey when they're 40, that means that they've got a shorter period to be earning compound interest on those contributions. So although it's still going to benefit them in retirement, it is going to be to a lesser extent at about $160 a fortnight in this case study. And lastly, for someone who is 50, they still do get a benefit by making those additional contributions to their super, remembering they're also getting a tax benefit here, and that's going to increase in this scenario their per fortnightly income by about $86 per fortnight. So even if you are getting very close to retirement, there is still potential and advantage in having a very big impact on your retirement income when you do retire. But as we've talked about, if you start that journey much younger, it is something that I wish I could go back and say to all of our members when they're young and maybe don't understand the opportunity. It really does make a huge impact when it comes to you in decades to come. Now, I'm going to hand over to Trustee in a moment, who's actually done a brief update for us. But before I do, let's just recap on what Pat's talked about and what Trustee's going to speak to. Pat covered off those pre-tax or concessional contributions, which is the main way for most of us that we have contributions go into our superannuation. But we also have another way that we can contribute. And this is what we call post-tax contributions, or non-concessional is the legislative term. And this is basically any amounts that you put into your super that you do not claim as a tax deduction, or any amounts that your spouse may put in where you have one on your behalf. There's different rules here, different limits, and so we'll hand over to Trustee to take us through that, as well as some of the government incentives that apply.
We're going to take a look at after-tax contributions, also known as non-concessional contributions. These contributions are when you have not received a tax discount when the money has gone into superannuation. So they've come out of your bank account and you've paid them into your own superannuation account, or you may have received a spouse contribution or be making a spouse contribution for your partner. There are some limits onto how much money you can get into superannuation as a non-concessional contribution. Essentially $130,000 in one financial year, or up to $390,000 over 3 financial years. And I will be taking a look at that further. Now, depending on what your income level is and how the contributions are received, you may also be entitled to some sort of government concession or top up to your superannuation. So I'd like to explore those a little bit now. First of all, we'll take a look at the co-contribution. So the way the co-contribution works is when you have made after-tax contributions into your superannuation account, and you might receive a little top-up from the Commonwealth Government depending on your income level. So essentially, there are some thresholds involved. If you are earning under $49,293 in a financial year and you have made a contribution of $1,000 into your superannuation, you simply lodge your tax return. The government sees what contributions you've made, they see what your income level is, and then after you've lodged your tax return, they top up your superannuation with $500 if you're under that income level. You can see on the screen there that that contribution does phase out once you reach the income level of $64,293. So essentially, you're still entitled to a partial co-contribution for personal contributions that you've made into super up to that income level, but it's a lower co-contribution, so not the full $500. So that's a government co-contribution which might be attractive for some people who are maybe not salary sacrificing or may not necessarily get the benefit of salary sacrifice. Let's also take a look at spouse contributions. So these involve a tax offset. So that is a reduction in the amount of tax that you would pay, and it comes off your tax payable when you lodge your income tax return. So essentially, if you make a contribution on behalf of your spouse into their superannuation account, when you lodge your tax return, you make note of that contribution, and depending on your spouse's income, you may receive a tax offset. So looking at the screen there now, if you have a spouse who is earning under $37,000 in a year, and you make a $3,000 spouse contribution, once you've lodged your tax return, you'll receive a government offset of $540. So that's a direct reduction in the amount of tax that you need to pay. And you can see that there still is a partial tax offset available up until your spouse is earning $40,000. So that's a nice little way to provide some money for your spouse and also reduce your tax bill. Let's take a look at these limits that I mentioned to you earlier for the bring forward rule. So after tax contributions, the government do want to encourage you to save for your retirement via superannuation. Superannuation is a tax-friendly environment. Your investment earnings are taxed at up to 15% when money is invested in super. So for that reason, there are some limits on how much money you can get into the superannuation account. If you have more than $2.1 million as a total superannuation balance, and that includes money in all of your super funds added up, so a collective balance of over $2.1 million, you won't be able to get any after-tax contributions into your superannuation. But if we look at the screen there, if you have got less than $1.84 million as a total superannuation balance, you can not only put in $130,000 in one financial year, you could put in $390,000 over a 3-year period. Now, once you've got over that 1.84 million, but under 1.97 million, you can still put in up to $260,000 over a 2-year period. Now, once you're nudging that 2.1 million over 1.97, but under the 2.1 million, you've only got access to $130,000 worth of after-tax contributions in one financial year. So I would like to show you an example of how this might work in practice. If we have our member here, let's call him Barry. So Barry's age 58 and he is expecting to receive an inheritance. So he's not made personal super contributions before, and he'd like to boost his super with money from his inheritance. He's expecting a total of $500,000, but that's going to be paid in 2 lump sums, 12 months apart. So $250,000 in one financial year, $250,000 in another financial year immediately following. So he wants to get this money into super. He's thinking about the best possible way to do that. So let's have a look at what he could potentially do. So when he receives his first $250,000, if he deposits that immediately into his superannuation account as an after-tax contribution, he has triggered what we call the bring forward rule, because he's put more than $130,000 into his super in one financial year. And that means over that financial year and the following two, he's got a maximum of $390,000 that he can put in there. So he puts in that $250,000. Then in year two, he was able to contribute $140,000. And that brings him up to that $390,000 3-year limit. He cannot make any contributions in year three. And then in year four, he is able to contribute the remaining $110,000 because there is no bring forward attached to that anymore. That's simply a $130,000 limit on that year. So Barry might think, oh, could I do this differently? What is a way to get that extra money into super a little bit quicker? So he might choose in year one to contribute $130,000. So he has not triggered the bring forward rule by making that $130,000 contribution. Then in year two, he can essentially contribute the remainder of that inheritance, the $370,000. So what he's done there in year two, he has effectively triggered the bring forward rule at that point. So he doesn't have any extra money at this point, but he could, if he came across some extra money, still contribute another $20,000 there, really. And then in year five, it would all reset again if he had additional money to contribute. So what we suggest you do if you are thinking about contributions into your super, particularly larger contributions that might involve the bring forward rule, ideally it's a great idea to get advice around the timing of those contributions. But we would also encourage everybody to take a look at our contribution calculator on the website. So this can help you with co-contributions, whether or not you might be entitled to a co-contribution or whether or not salary sacrifice might work better for you. So please, everybody, engage with that calculator. Think about what you might like to contribute and whether you can afford it. And the calculator will show you what your take-home pay will look like, whether or not you would be entitled to any co-contribution as well. And that might be some guidance as to what contribution type is best for you.
Thank you very much, Trudy, for that update. And it's great to actually be on the desk now alongside Pat. Thank you, Pat, for your earlier piece. We'll be coming to that in a moment. Sure. We've actually been receiving lots of questions from all of you, and I've been keeping an eye online, but we also had a lot of pre-submitted questions come in. So, Pat, what I'm going to do is I'm just going to throw these at you. I figure your main job is being on stage and taking just about every question you can imagine. So let's see how we go. So the first question, we've talked a lot about making contributions yourself and claiming them and things like that. But the first question was, how do I just go about setting up a regular contribution either through my employer, or is that something I can just do myself?
Yeah, sure. So it is reasonably easy to set those up. So if you do speak to your employer, chances are they will allow you to make payroll deductions. So have a chat to them about that. Obviously, if they do or do not offer salary sacrifice, that's another conversation you'd have to have. But another way that you could look at doing it is via BPay. So you could actually set up a regular BPay payment that comes out of your bank account straight into your super yourself. Another way you could do it, probably not as common, would be maybe to bring, say, a check to the ART office in Brisbane. Probably not as common as I mentioned. So you may be looking more at speaking to your payroll, asking if they can do a payroll deduction, and then, like I said, have that further conversation about salary sacrificing.
And importantly, a person can really change those contributions whenever they feel, can't they? So it's not like you're locked in or anything. They've got complete flexibility. Likewise, though, if they just want to make that one-off, that's probably where they think about how could they use BPay or something like that.
Yeah, so if they're just looking at a one-off payment, maybe they, say, won lotto or got an inheritance or whatever it might be, and it's just a one-off, that's probably where you'd look to do it via BPay.
And another question that's come through that is probably a bit attached to that, you'd mentioned it briefly in a couple of different ways, but how can a person keep track of what they've got going into the contributions?
Sure. So it's reasonably easy to keep track of that these days. So you've got a number of different options available. So you could log in to your ART account and actually see the transactions list there yourself. You could download the ART app and actually look at the transactions that way. But another way a lot of people don't realise, you can log into your MyGov account and see the information there. But it's important to understand that typically speaking on MyGov, it is a snapshot at 30 June previous financial year. So I would encourage our members, download that app. That way you can keep on top of what those transactions are.
And the other thing, I think, to simplify this a lot for members, we had the payday legislation come in on the 1st of July, which means now that people are getting their superannuation at the same time they're getting paid their income. Previously, that wasn't the case.
That's right.
So it's probably much easier for people to just know they've got those regular contributions going from their employer and they can track it through the payroll process as well.
Exactly right. So you'd see that on your pay slip as well, would be another way to keep on top of that.
Now, you talked about claiming a tax deduction. There is a process to that. Would you mind just again going through what that process is, that if someone makes a contribution themselves that they then wish to claim as a tax deduction, how do they go about that?
So in claiming a tax deduction, you do have to make that contribution into your super account before the 30th of June. It's very, very important. Now that would go in as an after-tax contribution. So that's what Trustee was talking about in her segment earlier. You then need to get that claim form off the ART website. You fill it out, let us know exactly how much of that contribution you wish to claim. You send that in to us. We will then acknowledge it and send out essentially a receipt that we've actually had that contribution and the claim form come through. Once you get that receipt, and only then, that's when you lodge your tax return. It's very important to wait until you get that receipt. If you lodge your tax return beforehand, it won't count as a tax deduction.
Thank you. And a question that's just come in here, which I might take first stab at, is can I actually contribute at different times with market? So I think it's talking about, can I time the market? I may be interpreting the question, this is coming in from John, but what I suspect you're talking about, John, is as we see markets fall, if you put a contribution in at that point, it actually has a greater value as the market then goes up. That amount that you put in at the bottom of a market, as the market recovers, it grows more quickly with the market. Timing is always a bit risky because we don't actually know when a market's going bottom out or when it's going to go back up. And that's where we sometimes talk about what we call dollar cost averaging. And this is where you're contributing regularly, so fortnightly or monthly or something like that. And it means that you basically benefit from some of your contributions are going to go in when the market's down, some are going to go in when the market's up, and really you're getting an average across that. So it takes out the risk of trying to time or putting in all your money at the wrong time and just averages it out. Pat, maybe thinking about though, if someone had a large contribution to make, is there any thinking in, again, thinking about the timing of that, or would you have a different way that you talk to members about it?
No, look, I would say the same sort of thing. Look, dollar cost averaging is a concept that a lot of people are aware of. So as Josh mentioned, it means that maybe on one day when you put in some money, maybe it only buys 2 units and the next day it buys 4, that kind of thing, but it averages out. So it means that you aren't timing the market. But no, I'd normally talk about dollar cost averaging as well. The only other thing would be to be aware of that after-tax limit. Remember, you can do 3 years of that limit all at once. So maybe if you do have, say, maybe you sold a property and you want to put as much money into super as possible, maybe looking at contributing just before 30 June, and then once it ticks over to the next financial year, then taking advantage of that 3-year bring forward rule.
I find it incredible you actually picked up one of the
next
questions.
So
I'll have to very quickly think about the next one. Questions come in here about, is there a way that I can contribute on behalf of my children? This is one we often get, or people people also thinking about how they can support grandkids and things. Do you have any views on that?
Yes and no. So, I mean, you can do that if you wish. I mean, one way to do it would be that you actually physically give them the money and they can contribute. You may be able to contribute into their accounts as well. Just be aware of age limits and things like that too.
What I was going to ask, where is there the advantage in giving them the money and asking them to contribute?
Because it would count towards their limit. So if you're putting it on behalf of someone else, it counts towards your own limits. Whereas if you give that person the money, then they contribute it, it counts towards their own individual limit.
And then you've got subsequent to that as well, if they're under the income levels where they could get a government co-contribution. So we often talk to people who'll have younger children who are starting in the workforce, for example, probably fall under those income thresholds and they qualify for the government co-contribution. So it's a really great way to give them that money, have them put it in themselves and it goes through their tax return and all of that process, and then they benefit from the co-contribution. Pat, we talked about this right at the beginning as the foundation piece. What are the steps if I know I've got multiple superannuation accounts? I think a lot of people think about the bad old days where the process was absolutely shocking.
When I started, you had to fill out a form and get it signed by a JP. So,
I actually once met a member who had 12 different super funds and just could not even fathom the idea of bringing them together. I've got a similar story. Yeah. But what, does it beat 12?
No, it was 10.
Okay. But now it's a far simpler process, isn't it? What's involved now if you want to bring your super accounts together?
Of course. So I would actually encourage everyone, log into your MyGov account, click on ATO and then super. It'll have all of your listed super funds there. It's very easy. It's literally a matter of clicking one box and then that'll roll it over to your new fund. So as mentioned, it used to be a bit arduous and people just wouldn't do it because of the process, but it's very easy these days. Log into your MyGov, have a look, and then you'll be able to roll them all there.
Brilliant. Thank you. Now, I'm about to start winding up, but before I do, the next session we're going to do talks about investments and while you're accumulating. Is there any wisdom or any thoughts you'd like to do as a bit of a segue between, we talked about compound interest and other things, but any closing thoughts on either contributions in general or thinking about how they work so beautifully with investments? Sure. Putting you on the spot. Sorry, Pat.
No, I would encourage everyone to make sure you're maximising that $32,500 as your before tax limit, because again, you do get those tax benefits by actually contributing that way. But the other thing in relation to investing, I do talk about it in my section in that session. I'll be talking about how that you can actually log online, answer a quiz and work out what kind of investor you are. Are you into growth assets, defensive assets? What sort of risk do you like taking? It'll only take you about 5 minutes, but it could have a massive impact on your overall balance. So definitely look at that investor profile quiz.
Wonderful. Thank you very much for your time, Pat. Thank you too for your presentation. I should just acknowledge we've had a number of questions that have come in around how you use contributions as you transition to retirement. We've also had a number of questions around recontribution strategy. We're not ignoring those. In fact, we're actually going to cover those off in a future episode, which actually talks about contributing towards your retirement. So if you do have any questions you want answered around recontributions, around transition to retirement and how contributions work at that time, please make sure you tune into that episode. But before we go, what I'd like to do is really encourage you to extend your knowledge and your thinking further than just watching this video today. We have some great online tools available to you. That includes our Take the Wheel digital program, which is a series of short videos that allows you to actually explore in bite-sized pieces ways that you can engage with your superannuation and start using some of the tools and opportunities opportunities that we have available to you. We also have our Super Insider podcast series. Lots of episodes which talk about investments, retirement, but also some of the fundamentals of contributing. Some of the questions we had come in fact, were actually around, should I think about contributing to super or actually paying down a mortgage? We actually have a podcast episode that brings in a specialist financial advisor to talk about exactly that question. So I encourage you to also listen to our podcast. But on that note, I'd like to thank you all for your time, for joining us. Thank you again to Pat and Trustee for their wonderful contributions to this contribution topic, and we look forward to seeing you next time.
Hi, I'm Simone Burnett from Australian Retirement Trusts. We've created Take the Wheel, a series of on-demand videos that help you really understand super and take control of your financial future. Over 12 bite-sized episodes hosted by these guys, you'll learn how to grow your super, invest with confidence, protect what matters, and make informed choices. Because your super isn't something that runs quietly in the background, it's your chance to jump in the driver's seat. So don't leave it on autopilot. Awaken your super. Take the wheel today. You never know, you could be sitting on a monster.